I could live in.
So I think you have to agree to the recording.
Oh, yes.
So here I am with my good friend Janice Jackson, and we're talking about the acquisition of this beautiful new ranch. And Janice and I have known each other for a number of years. And Janice, you've heard me talk about this before. Complexity is the enemy of success. And probably the simplest way to acquire this property would to acquire it in a company name. And that would be my recommendation because it gives you a lot of flexibility. So my take on it would be that there would be a company, and for the sake of argument, we're going to call that company that buys this. Just bear with me for a minute. We're going to call it uh, Farmers Drive. And I'm going to put the number in there. We're not 100% sure that we got the number right, but I'm going to put in 7545 Farmers Drive Inc. Okay? So let's assume for the moment that there's a company formed and it's called 7545. It could be a numbered company, but I prefer to name things 7545 Farmers Drive Inc. You could probably get that registered. You can register a company yourself. You can do a federal incorporation online. It costs about $350, or you can get your lawyer to do it. It costs a bit more. Okay? So my first recommendation would be that a company would buy this property. Okay?
When
Uh,
you say company, it's a corporation.
it's a corporation.
Proprietorship business doesn't cut it.
The business is separate. You made a very good point when you sent me your notes that buying the land and the farm, actually owning the property, is different than running a business. And that was a very big insight on your part. That's a good insight. And they should be separate. So Dustin and Heidi is his wife, right?
Yeah.
Yeah. Dustin and Heidi run a business called El Centro Equine Services, which is incorporated. And then there
No,
is, it's not,
proprietor,
I beg your pardon?
sole proprietorship
Okay, so they
company.
own it in their personal name. So that's fine. So they own a business called El Centro Equine Services, Dustin and Heidi in their own name. But I would strongly recommend, for a whole lot of reasons, estate planning reasons, financing, everything, you put it in the name of a company. And I just gave it a name, 7545 Farmers Drive Inc. 7545 Farmers Drive Inc., assuming that I got the address right, 7545 Farmers Drive Inc. And as I said a few minutes ago, or a minute or two ago, you and Dustin can just go online and incorporate it yourself. I think a federal incorporation is like $350, or you can get your lawyer to do it, and that might cost you $1,200, all right, or maybe $1,500, but you can certainly do it yourself. And then that would be step number one. Okay. Step number two would be to register that company for GST. Okay. And that's free to do. You can just go online and register it, and you can do it yourself. And again, if it's too complicated for you or for Dustin or Heidi, you can get your lawyer to do it. It costs a little bit more every time you call the lawyer. They don't pick up the phone without charging you a few $100s. But if it's too complicated, you can get your lawyer to register that company for GST. And the reason you do that is that once your company is registered for GST, that is before you complete this transaction on October 3rd, you can self-declare and not pay the HST. Okay? Or sorry, in your case, GST, HST in Ontario, but GST in BC. So that will save you in terms of cash flow 5% of $1,075,000. So it'll save you about, 52 or $53,000. Okay? You understand?
Yes, I believe that they have checked this out with their accountant because through their business, they are able to do that same thing.
Yeah, but sorry, I think we're confusing two different things. Going back to, again, about 5 minutes ago, Janice, the land and the buildings, the acquisition of the property is separate from their business. So they cannot.
No, no, we have to do commercial financing, so with the
No,
fund,
I understand that, but I'm telling you that the the business will be run by Dustin and Heidi. The property will be owned in some fashion, maybe by you, or maybe by you and Dustin and Heidi, or some other way. However it's done, you should separate them out. You should have a company that buys the property that's registered for GST, and therefore can self-declare and not pay the GST on closing. And I'll tell you why, because that's step number 3. Step number 4, and this is why I've set up hundreds of these in the United States and Canada. It's the most efficient way for a whole lot of reasons, is that the property, which includes, all the stuff that I'm looking at on the screen, the house that looks like a barn, the outbuildings, the paddock, all of these things. The business rents the property from the company, okay, that owns the property. So the property, including all the existing buildings, are leased to the business. Okay? It's extremely efficient, and what it will do is it will create a property ownership that will have its own bottom line, and it will create a business which already exists, which will have its own bottom line. And by the business renting from the property company, you are able to be more tax efficient. Okay? You're going to trust me on that one. We could spend an hour on the accounting of it, but you're accounting.
I understand what you're saying.
But so it's a tax efficient structure, but it's more than that, Janice. It's tax efficient, but it's also requires Dustin and Heidi and maybe yourself as well to make sure that the property is managed properly and is profitable, and the business is managed profitably. If you bring them both together, it's like a bowl of spaghetti, and you're not sure whether the business is making money or the property is making money or whatever is going on. By separating them out over the next 5 years or 10 years or however long Dustin and Heidi are living there, which might be 40 years, by having those two things separate, it will mean that you can finance the property separately from the business. The business can have its own lines of credit. The property can have its own mortgage financing. And 40 years from now, Dustin and Heidi, for example, could decide, we're going to sell the business, but we're going to keep the property. Or they could say, we're going to sell the property, but keep the business. Or they could sell both, right? There's a lot more opportunity for them down the road to maximize their returns.
And that has to be done right now, right?
Correct. Because if you don't do that, if you decide to do it later, which you might do, you're gonna in Ontario they call it land transfer tax. In Quebec they call it the bienvenue tax. But there's another phrase for it in BC. There's like a land transfer tax, but it's not called land transfer. What's it called in BC?
probably a property transfer tax.
I think it is a property. You're going to end up paying the property transfer tax twice. So I don't want to do that.
Like a property purchase tax. But this would be a
It's
transfer.
something like that. I could look it up, but it doesn't matter. So you don't want to pay the property purchase tax two times. That's a no-no. Okay?
Yeah.
All right. Now I got a few more questions for you. I'm sorry I'm a bit bossy, as you know, but we'll get through the whole thing. All right.
Okay.
And if you know, and as I said, I will put this on YouTube for you. It'll be unlisted, and you can share it with Heidi and Dustin, right? And they can watch it if they want to. Okay. So now, if I understand it correctly, to buy this ranch, which is absolutely beautiful, it's going to cost $1,075,000, and there'll be some closing costs, some legal costs and some property transfer costs or whatever they call it. But as long as you register for GST before your closing, you won't have to pay that. So your closing costs will be reasonable. Otherwise, they'll be $50,000+ higher in all likelihood. Okay. So when you purchase it, if I understand it correctly, you're going to put in the equity needed to close this deal. It's over 300 grand, I think.
I'm putting in 300 and they're putting in 100.
Okay. So I think that makes a lot of sense. So now the next question, and I did send all these questions to you, and you answered some of them. So you put in 300 and they put in 100. That's great. You'll have enough money to close the transaction. Very good. Uh, One of the reasons why I wanted it to be in a company is it's an efficient way to organize things, but it's also for estate planning. Breaking news, companies don't die, but people do, right? So one day you and I are going to go flap our wings and go see St. Peter, right? So it is a much better thing, in my opinion, for you just to have a company. It's a very easy to understand structure. And the question is then, who owns how much of that company? I understand that. So is it your objective that they should own 100% of this company? They should own 50% of this company. They should own 30% of this company. The company that will own the property, forget the business, because they own the business. That's already existing. How much of this property in your mind, should Dustin and Heidi own?
That was my question to you.
Okay, so I have an answer. Okay, if you're putting in 300,000 and they're putting in 100,000, in theory, it means that you would own 75% of this company and they would own 25%, right? I mean, the total is 400,000. You're putting in three quarters, so you would own 75%. But what you could do is you could say, you know what? I'm okay if I only own, say, a third of this company, and Dustin and Heidi can own two-thirds. Okay? And the way you would do that, okay, I'm not saying you necessarily do it, but this is a very simple way to make it happen. So let's assume for the moment that you wanted to be the minority owner. So if it was me working with my nephew, or my grandson, or for that matter, I've got five kids. I do it with my children and my I have five kids. I got two boys and three girls, and I got six grandkids. And so I did exactly this with one of my daughters, okay, because she needed help to buy her first home. She got married. They have two little kids, and they were struggling to buy a home, and they needed mom and dad to help them. So here's what we did. She put in, I think it was $40,000 of equity, and we put in, I think it was 360,000. Okay. So if you just did the simple number, she put in 40,000, mom and dad put in 360, that's 400,000. She would have owned 10% of her own home and we would have owned 90%. I didn't want that. So what I did instead was I loaned her, um, I don't remember what it was. I loaned her and her husband, I think it was 250,000 or 260,000. I think it was 260. So I actually loaned it to her, and I actually paid me a little bit of interest in it, like 4% or 5%. I don't remember what it was. It wasn't very much. But I loaned her and her husband 260. So now she put in, when we closed the transaction, it's a lovely duplex that she bought. Um, she put in 300,000 and mom and I put in 100,000. Do you understand? So now she owns three-quarters of it and we owned a quarter of it. But the good news from my point of view and my wife's point of view is that some of our money was coming back to us over time because we're getting older, right? So if you wanted to reverse those numbers, let's say you were okay with owning 25%, what you would do is JJ would loan uh, you would loan Dustin and Heidi 200K. And so your investment would now, your actual investment in this company would be 100,000. Okay. And their investment in this company would be 300,000. So they would own three-quarters and you would own a quarter. And there's another reason why I would do that with my nephew or my grandson or my daughters or my sons. And that is because when they own three-quarters of it, and something goes wrong, there's no question about who has to fix the plumbing when it breaks down, or the Vanguard unit, that toilet, the Cinderella toilet breaks down. They don't call Janice, who maybe is partying in Arizona come January or February. They call Dustin or Heidi, right? Because they own three-quarters of this thing. You're really pat. And the good news is that over time, that 200,000 that you've loaned them, or you could loan it to the company, is paid back to you over time. Even if it comes back, a little bit every month, that's okay. It gives you a bit of income. And the interest is taxable, but the principal is not because it's a loan, right? So you actually would have some money coming back to you. So that's a very simple thing to do if you're okay with that.
Yeah, works fine for me.
Okay. I think Dustin and Heidi would like it too because from day one they own 75% of this.
We were almost going to do a similar kind of thing where they could buy me out at any time.
Well, that's fine. I mean, you could lend them all of the money, and you could have 0% of this if you
Do
want.
it as a thing, yeah.
But what I would suggest that you continue to own at least 25%. And the reason for that is it will actually help Dustin and Heidi because
Yeah.
in the email that you sent me, you sent, in my opinion, you sold yourself a bit short. You know this stuff. You've been studying with me for a long time. You've done lots of courses. You've done lots of real estate. You have lots of experience, probably more than they do in terms of property. You probably don't teach much horseback riding,
Nope.
but you know a hell of a lot about real estate. So please don't sell yourself short about that. So if you own 25% of this business, great. If they ever want to buy you out, this thing becomes a huge success. You can have it valued, and maybe your 25% share, which is valued initially at $100,000, maybe it's worth $150,000 5 years from now, and they say, and we want to buy you out, and they could refinance the property and they give you $150,000 and they own 100%. That's fine. But the
Yeah.
25% ownership will give you a window into the world just to make sure, to the extent that you can, they're getting some of the benefit of your mentoring.
But um I'm part owner of the property, but not the business.
Correct.
Like, are we Yeah, okay.
So now,
Two.
you let me just finish. In
Yeah,
my opinion, you would own 0% of the business.
right, exactly.
The amount well, I don't know about you, but the amount I know about teaching, I like riding horses, but the amount I know about teaching people how to ride horses, you could put in a thimble and have lots of room left over. And
Yeah,
I imagine you're the same. My
yeah.
youngest daughter and I, we both like horseback riding. We go trail riding all the time, and we super enjoy it. She's a wonderful horse person. I don't know if that's a horse rider. I don't know. And she really rides better than I do, but I can keep up with her sort of. I love to do that, but as if this was my deal with my daughter or my nephew or niece, whatever, I would definitely say the business is yours. Now, the one thing that you have to establish, though, is the business has to pay enough rent to the property to make sure that you can pay your property taxes, that you could pay your mortgage, etc. So you don't have to charge them, rent as if they're renting the Empire State Building, right? But you and Dustin and Heidi can figure out, look, the property company is going to have to pay a mortgage, it's going to have to pay some insurance, it's going to have to pay some property taxes. So let's make sure that the lease from the business pays enough to pay that and a little bit more, right? So that the
So one situation we were running into was, okay, um, when it comes to things like a coverall for the property, a covered area for the riding ring area. Um, so is that become a land purchase or a business
That's a great
purchase?
question.
I
But
know that's the
no, no,
kind of,
no, yeah, I have an answer for that too. Okay.
okay,
You know me well enough to know that I think I'm a
you
know-it-all.
have,
Even when
I
I was
know.
a kid, I was a real pain in the butt. I was a know-it-all when I was a teenager, and I haven't changed in 60 years, right? Um, but anyway, I'm just writing notes for myself. So the business pays rent, and it pays enough rent for like I said, for the property taxes, for the mortgage, and for the insurance, plus a little bit more, just so that the property company has enough
Do
money.
I get any money out of that? 25%?
Yeah, 25%. If it makes if it makes $20,000 a year, you get 5 grand. But don't forget, the way we set this up, most of your money, at
Yeah.
least two-thirds of it, is coming back anyway as a loan over a period of time.
Oh, yeah.
So that's good. Now,
Yeah.
so there is another element to this, okay, which is really important. You're renting the house and the outbuildings that I'm looking at. I'm just gonna just so because we're doing a recording, I'm just gonna share my screen, my other screen here, and you should be able
There's a whole personal that comes into it as well, like for Dustin and Heidi. Corporation, business, personal is business, personal. Like,
we'll come back to that. You can you see my screen now?
yes.
So that's just I just wanted so we have a video recording of it that this is a truly impressive, beautiful property. And I guess this is a little bit of a Quonset hut.
Yes.
And how far away are you again from Kelowna?
Oh, 22 minutes from the mall, which is probably about the middle of Kelowna.
Yeah. Well, to me, this is a fantastic deal. And you've known me long enough to know that if I thought it was a really terrible deal, I would tell you that.
Right.
What a beautiful spot it is. Just love it. So I'm just showing these pictures so that we have it as part of the video. And there we are back to the main. So as we mentioned earlier, this looks like a barn, but it's actually the house. There's the Quonset hut. Not really sure what that is. Some kind of a shed. Another
Yeah.
shed here. There's the paddock there, and it's 10.75 acres or something like that. All right. So I've shown that to the video, so we'll have that. Okay. So the next thing is this is a little bit more. Now this gets a little bit more complicated. So Dustin and Heidi decide to put up a coverall building on this property. Okay? I don't know how big a coverall. Do you have any idea how many square feet it might be?
Oh, I did. Um, I don't know.
Well, I built and have yes, I built. I can't remember how many coverall buildings, but I built them from sort of like fairly small, 2,500 square feet, to fairly large, about 7,500 square feet. So, but there certainly you can. There's ones that you can get that are probably 50,000 square feet. So I have no idea. But the ones that I build that are say 3,500 to 5,500 square feet. By the time you buy the kit and you buy the concrete blocks, so that they're anchored, and you clear the land, maybe you pave it, and in this case it's for horses. Obviously, you have to condition the floor properly. The cost is about 50 grand for one of those. All right.
Yes, a little higher, like 100,000.
Yeah, so it's a bigger one. So it's, which is fine. It's
Oh,
probably 7,500, 8,500, or 10,000 square feet. Yeah, you're running horses in there. So it's $100,000 for the coverall. Okay.
yeah.
And so what what the property company would do, and I own property like this where I own a farm where I do exactly this. Okay. So if one of my tenants comes to me and says, I want to put a coverall on this building, on this farm, like I own a 27-acre hobby farm, I just like it. So on that 27-acre hobby farm, I've got tiny homes, I've got a beautiful event space, I've got a 4-bedroom, no, 5-bedroom um, farmhouse. I've got a small coach house. I've got a kennel. I've got a dog park, believe it or not. I've got garden plots. But if somebody came to me and said, I want to put $100,000, sorry, 100,000 coverall building on this property, would you give me permission when I have my property ownership hat on? So Dustin would have his property ownership hat on, and you would have yours on. You would say, sure. You would do it on the basis of a land lease. So you would lease them the land to put their coverall. So the property company would actually benefit from that. Okay? You're not paying for it. The property company has nothing to do with putting up a coverall building. That's something that is Dustin and Heidi's business. That's a business expense. And because you have no interest as a property owner of putting up a coverall building to train people how to ride horses. That's nothing to do with you. The property company is in the property business. That's it. And El Centro Equine Services is in the business of teaching people how to ride and maybe jump or whatever else they do. So if somebody came to me, I would say, okay, how much land do you need to put up this beautiful coverall building, with some additional parking and everything else? And you, as the property management company and the property ownership company, would say, okay, we're going to charge you some land rent for that, whatever it might be. It might be $1,000 a month. It might be $1,500 a month. But you would charge some land rent, and it could be a very long-term land lease. It could be a 10-year land lease. It could be a 20-year land lease. I mean, these coverall buildings don't last forever. The covers do, eventually have to be replaced. But usually every 7 to 12 years, we replace ours. They just, don't forget, Ontario has much, much tougher winters than Kelowna. Right? It's way, way colder, and we get -27. I don't think Kelowna gets -27.
We might get it for a couple of days,
Yeah, well, we'll get it for, weeks and weeks.
or maybe not quite that cold. Low
I
20,
think so. So
20.
we'll go from -27 to +27. Ottawa and Eastern Ontario is crazy. It's a desert. It's freezing and it's boiling, and like it just is. So it's very, very hard on these buildings, but they'll last 7 to 12 years. And Kelowna may be 12 to 15 years, but eventually you'd have to be replaced. So you can do a simple land lease. Okay, you've got this little area here. This is all yours. You build this building, make a ton of money from it. It's all yours, but you charge them some land rent. Okay. And as they put more stuff on there, if they put more tiny houses on there, if they put more whatever on there, the property company should get some additional land rent. That's what I do.
So then that means that the owner, if they want to leave, that goes.
Yeah, it doesn't belong to the property company. I mean, that cover all building. It's like, let's say they take your Vanguard unit, which Dustin and Heidi own, and they bring it onto the property. They should pay you they should pay themselves, if you will, and you a little bit. They should pay they could pay $250 a month in land rent where they put that. But all the income they get from that, let's say their son who is in third year, he goes off, gets married, lives in Tokyo for a while. They're going to rent that to somebody else, right? And for that Vanguard unit, the three that I've somehow inherited here, I get $1,450 a month for those things, which is quite a lot. So if Dustin and Heidi through their business rented it out, not to their son, but to somebody else for $1,450, because BC rents are pretty high. So if you got $1,450, they can afford to pay the property company $250 or $300 a month, and they keep the rest. Okay. And so they can, something else. Now, this may be a dumb idea, but I actually have a client who has something called Horse Country Campground. Um, Listen, it's just a suggestion, but they actually allow people to come and camp with their horses and their dogs. And you've got 10 acres here. I don't know, maybe it's all accounted for, but Horse Country Campground is pretty successful because it's hard to find a place where you can pull in and you've got a place for your car or your RV. You've got a place for your tent or RV. You've got a place for your horse trailer, and almost everybody who owns a horse owns a dog. And it's very successful. And so I'm not saying that they should do it, but it's something that maybe Dustin and Heidi maybe they say no, we don't want to do that, but it's a very successful concept because there are people who travel with their horses and they find it very, if you pull into a campground and say, yeah, I got my horse here, is that okay? Not, maybe you could keep the horse in the trailer, but in this case, there's paddocks and there's trails. So I just thought I'd mention that. It's a good business. They make a lot of money. Okay, so what other questions did you have for me?
Well, I guess that kind of covers the first question that I had. And then I had a question too regarding, did we cover exit strategy or?
Yes, we did. So the exit strategy for you, we'll repeat it. It's okay. I mean, this is, you got to remember, I do this pretty much every day. And so I do it all the time. So it's easy for me, I think, to remember this stuff because I repeat it so often. But the exit strategy for you is in two parts. One, to give Dustin and Heidi three-quarters ownership, you're just going to loan them 200 grand and they'll pay that back over time. So that's a form of an exit. And two, you're going to leave $100,000 of your money in this company that owns the property. And at some point, when the business achieves the kind of success that I'm sure it will, they can simply come to you and say, Aunt Janice, we'd like to buy you out. We think that your shares are now worth 150,000 instead of 100 grand. We've arranged a new mortgage on the property. Maybe that by that time the mortgage has gone from 700,000 down to 500,000, and they renew it at 650. They pull out an extra 150,000. They give it to you and wave you goodbye. Now they own 100% of the company, and they already owned 100% of their business. So it's a very simple exit strategy. Now, because you own shares in this company, should you ever travel, you know, up to see St. Peter, which for you and me is a lot closer than Dustin and Heidi, you can leave those shares to whomever you want. You could leave it to them.
That
You
was my question.
You could leave it to the Cat Society of America. You can leave it to whomever you want. So you would change your will and say, look, I own 25% of this company. Should I pass away, I want these shares to go to Dustin and Heidi or whomever.
So, like in my situation where it's a corporation that is involved in the property, and I've already made arrangements for the corporation, so I guess the shares I have in this company would go to.
Yeah, they would go to whomever you could leave them to me if you want. I'm kidding. But presumably you would, if you love Heidi and Dustin, which I'm sure you do, you presumably could leave it to them, or you might leave it to. Do they have any children?
Yes,
How many kids do they have?
two.
How old are the kids?
Third year university, I think he's like
Oh yeah, you mentioned that.
20,
Okay, yeah, third year university, and the other one.
grade 11. He just got his license. So
Okay,
he's
so
16.
if it was me, in my will, I would probably leave those shares to the kids. Just because if you transfer them to Dustin and Heidi, and presumably Dustin and Heidi would transfer them to the kids, there will be two deemed dispositions, right? You know what deemed disposition is, right?
Well, just gets passed down and down, right?
Yeah, but there might be a tax. I'm just a lowly engineer. I'm not a tax attorney. But I do know a little bit about tax. On our passing, Canada Revenue Agency, uh, somebody will have to file a terminal tax
Yeah.
return, and in that terminal tax return, say you left the shares to the two kids, Dustin and Heidi's two kids. You bought the shares for 100,000. Maybe they're valued at $150,000. So there's a $50,000 capital gain. And I think the government of Canada did not change the capital gains tax the way they planned. So about half of that would be brought into your terminal tax return, which would mean that, say you're in the 40% tax bracket, and there's a $50,000 gain, 25,000 would be taxable at 40%. So there'd be about $10,000 in taxes owing. If you transfer it to Dustin and Heidi, and then sometime down the road they transfer it to their kids, you're going to end up paying Canada twice.
Yeah.
And my dad, who was a brilliant economist, said, we live in a great country, be proud to pay your taxes. But then he would say, don't pay too much.
Yeah.
Yeah. You might leave it to the two kids. What are their names?
Except Dominic and Dylan.
Dominic and Dylan. Yeah. Okay.
Yeah. Like I'm purchasing this in my corporation name. And I've already made provision in my will that my grandkids are taking over the corporation.
That's fine. No,
So then would just be
perfect.
they would just get the shares from that,
Yeah,
right?
but there will be a terminal tax return, and you can be sure Canada Revenue Agency will have their hand out. We want $10,000 for this transaction, something like that, probably. So that's fine. Um, I like that. That's good. But if at some point you needed some money, for some reason, you're getting $200,000 back over time because you've loaned it and it's coming back to you. That's good. Um, and if you had to sell something, some shares in this company, you could, and Dustin and Heidi, assuming it's successful, could certainly refinance it and buy your shares back, if you needed to exit that way. So exiting is not really
Yeah,
complicated. This is
yeah,
the structure that I've described over the last, well, we've been at it for an hour now. Is tried and true. I mean, I could go into a lot more detail on it, but I don't think that would really pay any dividends here. I think you've got a pretty good sense of it. But what I'm going to do is, after we quit this conversation, like I said, I'm going to put this on YouTube unlisted, so it's not public, and I'll send you the link. And I think if you're comfortable, you could sit down with Dustin and Heidi and watch it together. And you're more than welcome anytime to email me with any further questions. And if you wanted to have a session where you and I and Dustin and Heidi got together, I'd be happy to do that. But we definitely have to make plans now for October 3rd, because otherwise you're going to end up paying, your property transfer tax twice possibly. You may have the wrong structure, and reconfiguring it afterwards will involve legal and accounting and taxes, and you're going to end up paying things twice. So you've got to resolve everything, in the next 3 weeks. And it sounds like hard to do, but it's not. I mean, if you and Dustin and Heidi agree that this is a good structure, it's not hard to put in place. So you can certainly do it in 3 weeks. Okay?
oops.
I hope I didn't go too fast.
No, I understand what you're saying.
Okay.
Yeah.
All right. Well, I think we've beaten it to death for now. Remember, you
So
reach.
are you going to do up a written
Oh, no, the
explanation?
reason I recorded it is so you have it,
Okay,
yeah,
that's
you
what.
have the recording and you can go back and you can slow
Okay,
it down, you can take more notes. It just saves me a hell of a lot of time, because to write all these notes out would take me longer than it does to
yeah,
to tell you. So you have to do a little bit of work, but I would strongly encourage you to look at it again one more time yourself, and then go and sit down with Dustin and Heidi and say, look, this guy actually knows what he's doing. He's done this for literally now thousands of people across Canada, the United States, and a few overseas. I mean it. I know what I'm talking about. I'm not perfect, but this structure has worked again and again and again over, decades now. Okay. All right.
yeah,
Okay. And I just wanted to say how glad I am to see you again, Janice.
yeah. Thank you, Bruce.
All right. So in about half an hour, you'll get the link. Okay.
Okay,
All right. I'll see you soon. Okay. And reach
thank,
out to me anytime.
okay, thank
Bye
you.
bye. Thank
Bye-bye.
you.